Imagine you've spent the last 20 years building a successful business. Your corporation has accumulated significant retained earnings. Your investments have grown, your mortgage is paid off, and financially, you're in a strong position. At that stage, the conversation often shifts from simply building wealth to thinking about how to protect it, preserve it, and eventually transfer it as tax efficiently as possible. That's why many successful business owners eventually begin considering participating whole life insurance inside their corporation. Why consider life insurance at all if the business is already doing well? Because the need isn't necessarily about replacing income or covering a short-term risk. It's about preserving your corporation's value and business planning. Let me explain. As businesses become more successful, many owners leave excess profits inside their corporation, rather than withdrawing everything personally. In many cases, that's a smart move. Corporate tax rates are generally lower than personal tax rates, and withdrawing funds often triggers immediate personal tax. Over time, those retained earnings may be held as cash, or invested in GICs, stocks, ETFs, mutual funds, real estate, or back into the business. However, there's an important consideration. If a corporation earns too much passive investment income, it can reduce access to the small business deduction, resulting in a higher corporate tax rate on active business income. As wealth grows, the conversation often shifts from simply investing to planning. How can I continue growing my corporate wealth tax efficiently? How can I ensure more of that wealth reaches my heirs rather than being lost to taxes? For many incorporated business owners, a participating whole life insurance owned by their business becomes one of the most effective tools to grow wealth tax efficiently while creating a tax-free legacy for the next generation. Corporate-owned whole life insurance simply means the corporation owns the policy, pays the premiums, and receives the death benefit. When that benefit is paid, it's generally received by the corporation tax-free. From there, some or all of the proceeds may also be paid out to shareholders tax-free through the capital dividend account, or CDA. The amount that can flow through the CDA depends on the policy's adjusted cost basis. Think of the ACB as the policy's remaining tax cost. The lower it is, the more of the death benefit can generally flow through the CDA tax-free. This ability to create a tax-efficient transfer of wealth is one of the reasons corporate-owned whole life insurance is often considered as part of a long-term tax and estate planning strategy. Here's an example. Let's say your corporation purchases a participating whole life insurance policy with an initial death benefit of $1 million. Over time, the policy can grow in two ways. First, the policy builds cash value. By age 75, that cash value could grow to nearly $2 million. Second, the death benefit may also increase through policy dividends, growing from the original $1 million to approximately $3.15 million. The business needs access to funds during the owner's lifetime. It can often borrow against cash value while keeping the policy in place. When the insured passes away, the corporation generally receives the death benefit tax-free. Now, let's assume the policy's ACB is approximately $60,000. In that case, about $3.09 million may be credited to the corporation's capital dividend account. This allows most of the insurance proceeds to be distributed to shareholders as tax-free capital dividends, subject to applicable tax rules. The big picture is that corporate-owned whole life insurance can help grow corporate wealth, provide access to funds when needed, and create a tax-efficient way to transfer wealth to the next generation. Corporate-owned whole life insurance can be a powerful strategy for business owners looking to build wealth, create liquidity, and support long-term planning. If you're an incorporated professional or business owner with retained earnings, it's worth exploring how this strategy may fit into your financial plan with your advisor, accountant, and tax professional. We've put together a guide that explains how corporate-owned life insurance works, the key tax concepts, and when it may make sense for your business. Click the link below to learn more.